Portfolio Builder members, welcome to our diamond level trade alert. This is for generating a higher yield than the SPY ETF. And so far it's outperformed by twice, so twice the income. And you only have to trade on Tuesdays. The catch is this is ideal for portfolios that are over $150,000 in size. Now, like I said in the alert, if you do want to follow this with less than $150,000 to start out, because you want to only have to do one trade a week instead of three, which the SPY requires, then you can optimize this to either only hold the Microsoft position or the banking stocks, Bank of America and Wells Fargo. So that's how I would go about it if I were starting off with less capital. I enjoy just doing the Tuesday trade, but I want to get a higher yield than I am from the SPY. And so the first step is to locate your spreadsheet, which is in step 1 in the written instructions in our email. And you're going to want to come over and insert your deposit. So I start off with the $150,000 deposit, the minimum to accurately build out this portfolio. Next step is it will create a trade alert right here with how many shares to purchase. And so you can see my purchase today. If it's a sell, you put a negative. If it's a buy, you put a positive, or just a normal number. And this will automatically populate up here. We only want to own multiples of 100 shares of each security. And that's because we're using covered calls every week to protect our portfolio, as well as generate income. Now, the pros to this is that you can generate about twice the income, again, relative to the SPY, and you can do it with only 1 day of work a week, whereas the SPY ETF, we're doing it 3 times a week. The downside is that while it's hard to manipulate the entire S&P 500, it's relatively easier to manipulate a single stock, and you will find from time to time big hedge funds who specialize in shorting stocks will go after and attack these top names in our portfolio. And so that's something that this strategy has an advantage, because we can see when that's happening by looking at the short interest and the amount of volume pumping into put options against the underlying security. We can have a good idea if it is currently under attack. And if it is, we just simply lower the strike price on our covered call for that week, and we can play it safe. So you'll see right now there's a huge position in the shorting the stock and in the put option market against Apple, whereas the most of these other stocks are now just leaning towards a bullish slant when you look at the option volume. Here's where I've placed today's trades. So the plan is we write the covered call on a Tuesday, and then we buy it back the next Tuesday and write a new covered call. So when you're first starting out, step 1, buy the stock. Step 2, write the covered call. The next week, instead of purchasing the stock, you're just going to buy back your covered call and then issue a new covered call. And so we're getting different yields today, depending on how safe we're playing it. But you can see, in general, this is about twice the yield that we're getting on the SPY. And simply, this is made possible by just getting rid of the cushion between us and the underlying asset, which is what the SPY does for us. Now, just reviewing the trade alert, and then we'll look at some other charts and interesting data. Again, this delivers approximately twice the income, and it has 1/3 the work in terms of how often you have to trade. The work we are putting on is about 8 times as many trades, obviously, because there's 8 securities in our portfolio. And these, again, are the largest positions in either the SPY or QQQ ETF, stripped of companies that are too expensive to fit into a $150,000 portfolio. So we've gotten rid of Google, Amazon, and Berkshire Hathaway. Now, this portfolio is very correlated to those stocks anyhow, and the Apple, Bank of America, and Wells Fargo actually represents almost half of the Berkshire portfolio. So once again, by stripping out the intermediary broker, which in this case would be Warren Buffett, we can get a higher yield with the same thing. We trade once a week only, and the program is designed to protect our capital, so we don't need to be reacting to any kind of emergency alert. This portfolio will only be touched at 11 a.m. Tuesday with a video trade alert and written instructions followed by a Q&A webinar. And again, if you do join us on a webinar and attend, we'll give you an extra 7 days on your free trial. It's ideal for portfolios over 150,000, but not a requirement, who want to generate approximately $5,000 a month of income from writing covered calls against the underlying asset. And this palette of stocks will probably only be updated about once a year, and it will reflect changes in the underlying assets held in the S&P 500 or the NASDAQ. So we're simply looking at where is the most money being stored for the long term. And that is this list of companies. They have the great option market for writing covered calls and massive stock buyback programs on each of these. So there's a good argument that this portfolio's underlying assets could have, in the long run, less volatility than the complete S&P 500, because not all of the S&P 500 companies have enough profits to be rolling out tremendous billion-dollar-a-month buyback programs like Apple. And as I said, if you do want to start off with less capital, all you would have to do is alter these allocation settings up here. So if we wanted to start off with, say, a $12,000 portfolio, you might put 90% on income, 0% on high yield, 10% in cash. We want to have the cash available to put on our hedge when the time comes, and that would be when we were worried about serious downside. And I most likely won't be worried about that until either the central banks are raising interest rates, which they're not yet, or China trade war breaks down and escalates with further tariffs, or signs of inflation began to start creeping in, or a great other list of potential risks. So we're on high alert for that, and we want to put 9% into an in-the-money call option on the VIX and a 1% out-of-the-money put option on the QQQ to properly protect this portfolio when the time comes. So that would be one option. The other option, if you want to play it safer, then I would recommend the bank stocks. This is something that has to be supported by the government. There's no way Bank of America will not be bailed out by the government if things get rough. So this is potentially the safest long-term strategy for generating retirement income with the Diamond program. And right now, the banks have been beaten up, so they do have very nice yields. But in general, the technology stocks will have the higher yield on the covered call. Okay, so I'm going to go back to our default settings, which is what your spreadsheet starts at. And let's take a look at how we chose the current covered calls. So I'm back at the Word document, which is converted into email, HTML, and sent to you guys. And let's take a look. So here's a summary of all the trades. You're not going to get these exact prices, so don't expect that because the market's always moving. We're getting this out as fast to you as possible and then doing the Q&A webinar. Again, the format is sell to open. One, we're always going to be writing the covered call, not this Friday, but the next Friday, and then rolling it over every Tuesday. And in terms of how we're picking the strike prices, there's no way I could put every thought into each update and get it out quickly. But number one, we're paying a lot of attention to the general macro view of the total market for positioning in our strike prices. Number two, we're then reading intensively all the information flowing about these 8 securities, and this does give us a better idea of the macro view as well. But finally, the real thing that makes the biggest input into where we write the strike each week is going to be looking at the trading volume. So we can look at both the put option trading volume, and you can see almost no one is betting that Microsoft will go down next week. And if you look at their chart, you'll understand why. This is one of the strongest companies, and why, if you have less than 150K to get started with, this would be the best stock. It's probably the most important company in the S&P 500, and it's the largest position at 5% of the SPY. So the 120 strike price is where a lot of trading volume is flowing through. It has a healthy 65-cent yield, and it still has $3 of potential upside in the underlying asset. So we can definitely get a very nice return on this trade alert this week, and it's a bullish position. If we look at that chart, you can see Microsoft is one of the most resilient companies in the world that continues to outperform relative to other tech companies. Okay, so Apple came out with 1 million new products yesterday. They're moving into the services industry, but they have a lot of competition, and they're starting to saturate the high-end market of the cell phone business. And so right now there is a tremendous amount of activity trying to short sell Apple, and we can see it in the trading volume today. Lots of trading volume pushing through. But right now our general outlook is bullish, so I have chosen the 190 strike. So if we were to get assigned, we would be essentially collecting $4.40 per share and doing very well. However, if we don't get assigned and the stock does travel lower, we have approximately $4.40 of protection. And if it trades less than that, we're generating a profit on this covered call. Now, everybody knows this is the #1 largest position of Warren Buffett's portfolio, and the company has more cash than many countries have in stockpile, and all they're doing with it is just buying back their own stocks. They don't know what to do with all the money, so it's a difficult stock to attack as a hedge fund. But you can clearly see it's happening right now. Facebook, everybody's always scared about Facebook. Meanwhile, their revenues continue to grow and grow and grow, and nobody who uses the platform really cares about the privacy issues, just the investors. This stock, we chose the 172.50 strike. Now, as we go down the list, you'll see there's a lot less trading volume, and this is the Intel trade. We chose the 53.50. There wasn't a lot of trading volume up in the higher range, and there's not a lot of put options being sold. So this is why we chose the 53.50, right at the money covered call. Cisco. Big volume right at the 53.50. We chose the 54, one strike above, expecting it to probably push at least 50 cents. So we can enjoy some upside in the underlying asset plus the $32 credit per 100 shares from the covered call. Comcast, very little put option volume, anticipating a downturn, and a decent amount of call option volume. So we chose the 40 strike on this trade. Bank of America. Bank stocks have been getting beaten up from the dovish surprises of the Fed. At least that's the excuse they use. We can see the trading volume is highly skewed to the bullish side, and we chose the 28.50 strike. So this gives us $1.50 potential in the underlying, and we can still capture part of that 8-cent credit per share. Wells Fargo, once again, still getting through its recent scandals, and trading volume is heavily skewed to the bullish side, so we chose the 50 strike. And once again, we can enjoy $1.50 of potential upside in the underlying and still capture part of the covered call. And so to summarize, we are, for most part, bullish in today's trade alerts and have the potential to enjoy some profit from the underlying asset if it's trading below our strike but above the current price, and also enjoy some of the credit from the covered call. Now, if the stocks go flat, we'll keep the entire covered call and also do very well. And if there's any downside, then the credit we've taken in today will help protect against that downside volatility and continue to create income next week and the week after and the week after. So if you have any questions, please join us on the webinar, and we look forward to getting the new Diamond Level Trade Alert out next Tuesday, same time.